amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second win.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with a steward's view. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. With your host, Aaron Kolkman, president of Fadir Advisors in Minneapolis. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time with a steward's view. A Steward's View is brought to you by Fadir Advisors, a registered investment advisor. You can listen to this podcast and previous episodes at fideradvice.com. That's FIDERE advice.com. Now here's your host, the president of Fadir Advisors, Aaron Kolkman.
Welcome back, everybody. Welcome to Steward's View, a Steward's View. So glad you joined us again. Remember to visit this and previous episodes on our website and subscribe at no cost. Follow, like, and share on your favorite platform, SoundCloud, Spotify, and soon iTunes. Today we will revisit a little bit of last week and the program and then get into the weekly update we have for you. Every week we aim to help you be wise and decide well. That is the mission of A Steward's View. Each week we'll bring you the economic, investment, and planning thoughts to equip your decision making. Each week will be a little bit different from the previous one, but every week we want to give you a sense of the macro environment, that is the big picture, and considerations for how to navigate it. We'll introduce you to special guests, subject matter experts. These people are amazing, and I'm so glad that we can start that process today. And we'll give you some fresh thinking from them and from yours truly for the current buzz. And so now let's dive into this week. Chaz, anything else for this week?
Well, buddy, I'm really excited that we have our first guest. But, you know, we did a mean radio tease last week, and we didn't return to it. You were given all of your letters. What do you call them? The credentials, important stuff. The CF, this and that, not all the things. The masters. I said, "Are you a doctor?" And you said, "No, only my brother's a doctor." And I said, "Oh, you really?" Mm-hmm. And then you said, "I have a joke." And said, "Okay, we'll get back to that. We got to stay focused." And then we never went back to it. So there's a couple people like going, right. What's going on?
Well, I kind of hesitated, right, because I have this concern that I might seem a little off color with my joke, but I ran it by you already, so I'll just tell you where it comes from.
Okay.
When I've been in situations where I've needed health care and I go in with my insurance card, I think you maybe know what that feels like, and you give them the insurance card. Mm-hmm. Typically, they don't just say, "Oh, let's give you an idea of what this is going to cost."
Yeah, there's a lot of ambiguity. Okay. Well, we'll see.
Yeah. So you just give them the card and your identification and you go get a service, and then days or weeks later, you find out what it cost. Mm-hmm. Okay. So that was what I was alluding to in my thinking about, and I think I mentioned a certain model and way of doing business in our industry that could work like that, right? And how you can actually make a lot of money doing that. And then I said, I have a brother that's a doctor, and truth be told, I want him to do well. I just would prefer a lot more disclosure at the beginning. Okay. So with that, the joke I didn't tell, and I'll just apologize in advance if anybody finds this offensive. This is a Christian program, and no, we're not going to get into eschatology, but two doctors and an HMO manager die and line up together at the pearly gates. One doctor steps forward and says to St. Peter, as a pediatric surgeon, I saved hundreds of children. St. Peter lets him enter. The next doctor says, as a psychiatrist, I helped thousands of people live better lives. St. Peter tells him to go ahead. The last man says, I was an HMO manager. I got countless families cost-effective health care. St. Peter replies, you may enter, but you can only stay for 3 days. After that, you have to go to hell.
There you go.
Okay, so there it is. A little anticlimactic at this point, perhaps, but maybe somebody's smiling.
There you go. Good. Hey, should we get to our guest?
Yes. So, yes, quickly. We have the unique opportunity this week to hear from Chris Gerber, who is a portfolio advisor at Fadir. Chris is now I'll guess at the exact number, a 39 or 40-year financial industry veteran in portfolio management and financial planning. He is a former investment advisory committee member at Lincoln Financial Advisors and SageMark Consulting, and a former portfolio manager at Strategic Wealth Group in the Twin Cities. Chris has brought together the technical aspects with me of the 5 strategies that are currently being run at Fideer Advisors, and those are available online at fideeradvice.com/models. Those are examples, not composites. But Chris has brought that technical expertise, that deep level chartered financial analyst expertise, if you will, to Fideer, and has shared that willingly in his, dare I say, 4-decade span of experience. So it's been wonderful to have him around. He's somebody that I look up to in many ways and have learned a lot from. So with that, I'd like to welcome Chris Gerber. And Chris, are you with us?
I am here. Thank you.
Great. Welcome, Chris. And I'll just add that to find Chris online, you can visit fideeradvice.com/Gerber. That's Gerber. So, Chris,
yes,
lots happening this past week since the previous program, and I'm quite sure that you have something to say about it. What are you thinking right now, and what do you think is most important for us to hear for today?
Okay. Well, first of all, the economy creates a lot of stress in a lot of people, stress between husbands and wives, between people paying their bills and so on. And because of the new administration and the new direction that we're going to be going, it's probably going to create some stress for a while, but long term, I think people are going to be very happy with it. And I'm going to characterize this by looking at a number, and that number is 25%. And right now, about 25% of gross domestic product, which is all of the transactions in our economy, which is big, about 25% of GDP flows through area code 202, which is Washington, D.C. And that's a large percentage flowing through bureaucracy, which is why the Doge thing exists and why we're converting our economy from a government bureaucracy-driven economy back to a private sector-driven economy. So we're going to be deleveraging government, and we're going to be emphasizing private banking once again. In other words, community banks and so on, who actually used to play a very large part in our banking system. But research has shown that since they have gone away by design of our bureaucracy, that has been a very large negative impact on the growth of our country, of our economy in our country. So broadly, I would expect that, we're switching back, and it's largely because if we don't, I think we're probably at the last roundup, so to speak, of if we don't do that here at the last roundup, then we probably will devolve into a European-style economy pretty quickly. And many people don't really know what's going on over there, but broadly, living here is still a lot better. But if you want 100 and 150-year mortgages and little tiny boxes to live in and all kinds of womb to tombs type stuff where they say they're going to take care of you, but realistically, you see people almost sometimes rioting in the streets for what's going on economically. It's a different world, and the current administration is designed to theoretically stop that. Now, some people might not mind that, but economically, that's high debt, lesser productivity, and I would say, when I say lesser productivity, what I mean is it isn't so much the American dream as it has been over the years. So I guess that would be my opening salvo on this, is that we're going through a massive restructuring here, and it's happening now.
And so, Chris, I'll maybe start with a headline that may fit with what you're referring to, and that is the reordering of GDP. Right. A couple of weeks ago, we talked about GDP and the U.S. is standing in the world and the components of it. Right. So I just heard you say that we've got this government component shrinking, and the expectation or the effort is to have the private sector, which would be business, right, that component increase, right? Because consumer spending, there was mention of a capped consumer spending that's real, right? That was 2 weeks ago. But the business component, if I'm understanding you, you're referring to that piece growing as time goes on through this shift that we're experiencing right now.
Correct, because right now government spending is roughly about 20% of our GDP, roughly. And that is, we would consider that historically a fairly high component of GDP. So we want to see, and when we think about the fact that government by design is not productive, it's simply taking transfer payments. It's taking money from us to fund them. Now, one other thing that's occurred in our government and many other governments over a long period of time is that we've essentially given government our credit cards. So not only are we giving them our money from taxes, but we're giving them virtually a carte blanche to spend as much of our future income as they want to. And they have jumped on that because obviously it makes government bigger, but there's kind of a big word, a big phrase. There's something called a Ricardian equivalent. It's Ricardian equivalent that government has been running on for really heavily for about the last 25 years. And that essentially says that when they borrow something, people will automatically say, oh, the government borrowed money to give us consumption now, and we will, in our own little homes, start setting money aside to pay that interest and that money back later. Well, that doesn't happen. People don't think like that. They use their paychecks and they typically use them up. So people really don't save for future taxes. And so we end up with simply higher and higher debt that's never paid off to the point where obviously debt, I'm going to shoot ahead here. I can probably find the date when debt could be it's expected to be basically 100% of our GDP. It's becoming a larger and larger piece of everything we spend. I think it's number 3 on the government spending list. I think that it now exceeds defense, but Social Security is the big one, and Medicare might be number 2. I'm not certain, but I can find that on the computer here very quickly. But debt is right up there. And so we're getting to the point where, if you can imagine, if you're a family and you borrowed so much money that your entire paycheck is really close to being taken up by debt, that's where we are. So we are not exactly totally backed up against the wall, but we're awful close if we want to maintain the American dream and our way of life. And our way of life is not being a slave to debt or to usury. To surety. We're not really that kind of a country. We haven't been built that way, but we're becoming that way.
So, Chris, I may be throwing you a curveball here when I look at an article that came out on March 12th, just after we recorded a Steward's View a week ago. Ray Dalio,
okay,
well-known hedge fund manager, came out and he said, if you think the current outlook is bad, just wait until the White House can't find anyone to buy its debt. So that speaks to a little bit of what you're saying, I think, in the sense that, we can only hold so many bonds and portfolios globally, right? Before those bonds are worth less. Okay. Not worthless, but worth less, 2 words. And so now this caution being thrown, it might be premature, but it's still coming from a very experienced, very macro kind of mind at the level that we're talking about. So what say you to that point?
I think we're a ways away from that. However, something that we've noticed recently. I think this gives people a feel for what they could expect if that happened. In the last few weeks, the international stock markets have done better than ours. Okay. Now, part of that is because there's uncertainty in our markets, and I think it's largely because they're being told to be uncertain by the media. Because in a cross section of America, how many people believe and understand what a tariff really is? Not many, and they shouldn't, because that's not what they do every day. But the other part is that the differential in our interest rates here between us and, for example, Europe, that difference between the two, they call that a spread between the two, that's actually gone up as our interest rates have gone down. Okay, so as our interest rates don't look as good, as our interest rates go lower, that means that, people around the world will have less of a propensity to invest with us because we pay less. Why pay us, for example, 1.5% for a bond when they can go over to Europe and get 3% for a bond, for a similar bond? Now, that bond may or may not be as good a credit quality, or maybe better technically, but it's simply better. And our interest rates go down and the important part as our interest rates go down, I should say it this way, is that everything is a moving target in finance. And that's what a lot of people don't really understand. There are very few, what would be a good way to say this, Aaron? There are very few absolute things in finance. They are always comparative things in finance. So as that moving target changes, people's behavior changes. Mm-hmm. So our rates are down. People are not going to put their money as much in our fixed income or bond market, so interchangeable terms. And not many people understand our fixed income / bond market is massive, massive. And as that happens, that means the capital flows to our country reduce and it goes somewhere else. So, okay, what do we do to kick up our bond rates, our interest rates here? Well, they're only so high that we want them. If our productivity goes low enough and our activity goes low enough, we have to spur the markets along with interest rate cuts. This is what makes this hard. This is not an easy, if it was easy, everybody'd be doing it, right? This is what our Fed has to deal with and our Treasury has to deal with also.
Chris,
go ahead.
I don't want to interrupt that thought. I do want to mention, to tie that thought to our program last week, and we'll take a break here in a minute and have you talk a little bit about this, if you would, and that is the flatness of what investors get in terms of interest rates when they're investing in bonds, U.S. Treasury bonds in particular, right now. Okay, the flatness. What do I mean? The shorter end of the Treasury bond spectrum and the longer part of the Treasury bond spectrum. Okay, that yield curve, as it's called, is very flat right now. So there's very little difference between what I get in a 2-year bond paying 4.02 as of last Friday. That's 4%, 0.02, and then the 10-year at 4.31. So let's come back and talk about that and maybe a little bit of the why. And then let's remember this. We want to really get into the navigation of this. So I'm looking forward to that with you, Chris, and thank you for joining us in the first half.
More of A Steward's View in just a moment. Investors have stocks, bonds, mutual funds, ETFs, options, futures, real estate, and more. There's one place to look at all of your portfolio. It's called Fusion, Portfolio Aggregation. No contract, no hassles. Fidere's portfolio technology gives its users a chance to see all of their assets all the time, wherever they are. The Fusion platform is open for use without a contract and without a hitch. It's based on mean variance optimization and analysis research by Aaron Kolkman. Fidere uses the Fusion platform to optimize assets for its clients. For more information, visit fidereadvice.com and click on Fusion at the top of the page. That's Fidere Advice, F-I-D-E-R-E, advice.com. Now back to A Steward's View with your host, Aaron Kolkman.
We're back for the second half with Chris Gerber, CFA, portfolio advisor at Fidere. He is a 40-year veteran. Chris, you've not yet refined that number, so I'm going with 40. Is that about right?
I think you're close. I'm getting up there.
Okay.
It's at least 39.
All right.
Okay.
Well, welcome back. And we're going to dive right back into where we were in the first half, and that has to do with bonds. And for those listeners who are new to this program, we're orienting this program to help listeners be wise and decide, well, okay, that is to say we want to help them navigate what they're doing on a strategic or a macro level, giving them some tidbits or some maybe even salient points on economics, investing, and planning, right? And we haven't really, Chris, been into planning points at this stage. Very few investing points, actually, too. Those are coming up more as we get into April. But for now, we spent a lot of time in economics in the backdrop, an outlook for this year. I shared 2 weeks ago, and then last week we talked a little bit about this issue of interest rates and the role of interest rates and how they behave and who's doing what in that. So the Fed was the mention and how they operate and deal with both short-term and long-term interest rates. Okay, and I just referenced that. So now you're here, and we get an opportunity to hear from someone with your expertise at your level in regards to what's going on with interest rates, and less maybe about the Fed and its role, and more about how do we consider this as investors, right? And maybe we even want to define what fixed income is or what a bond is. I'll quickly say with bond investing, we are invested in the act of borrowing. Right. So we're borrowing or lending is a better way to say it. The government or the issuer is doing the borrowing. So I'll flip it to the investor here. I'm sorry, but we'll do the lending to the government by buying a bond, or to a corporation or any entity that's issuing this bond. Right. It's called fixed income because, like other instruments that are similar, you would get a fixed interest rate back, much like you would in a bank CD, right, or some other fixed interest investment. So bond investing, you think of it as being a loaner instead of being an owner. Okay, so that's where we are. But Chris, if you could help our listeners get a little bit about what's going on with the bond market, maybe something about how to look at it and how to consider it in what they're doing.
Certainly, for the listeners, one of the probably most important understandings would be that the bond market and the stock market are the two major markets. Pretty much everything that we invest in is built from one or the other, or some combination of those two things. The sexy thing is the stock market. The bond market is something people don't really understand. So understanding, first of all, the bond market is actually bigger than the stock market. There's a lot more transactions, a lot more breadth to the size of the bond market. And bonds are typically considered borrowing and lending versus owning equity, and something that you kind of guess is, it's going to make money maybe. Well, bonds are going to make money. It's a question of, if you hold them until maturity, and so it's just like a CD at a bank. That's essentially a bond. And you pay the bank for that bond because they tell you something that says substantial penalty for early withdrawal. That means you can't get your money out with a 6-month interest penalty typically. Whereas in the real bond market, the values vary by day. You buy a bond that might be a 30-year bond at 5%, let's say from a corporation. They're going to pay you 5% for 30 years and give you your money back. Now, along the way, if you want to get your money out, you don't have a substantial penalty for early withdrawal. You actually simply go out to the bond market. You call Aaron and say, Aaron, I need to get my money from this bond. He goes, let me go to the market and see what it's selling for today. And those prices are always going to be compared to, remember you put in, let's say, $1,000 for that bond. Well, if interest rates have gone up, you're not going to get quite $1,000 for that bond, because yours is paying 5%, but now they're paying 6%. The competition is their brand new ones being issued for 6%. Well, your 5% was going to sell for less. That's how it works. And vice versa. If interest rates went down and they're at 4% for a similar type of bond, similar credit quality, then yours might sell for $1,100, and you might make profit and go, Aaron, you're a genius.
So right now, what's happened is we have 4.02% on a 2-year bond is the yield as of Friday, and the 10-year at 4.31. These are treasuries. So, so the U.S. is, we're talking about bonds that are currently in circulation, by the way, right? These are not new bonds. So you just described what circulation looks like. How do we deal with this? I mean, I made the comment a week ago, we've got, very little incentive to go out anywhere past short term to be an investor in bonds or fixed income. So what say you, Chris?
Here's what we think about. Number one, what happens in the bond market will typically have a massive impact on what happens in the stock market. Now, historically, bond yields have gone down over a long period of time. And as those yields have gone down, they are less attractive to investors. And as a result, they look for places to put their money, and stock market has gone up broadly. So stock market's way up over the last 30 years, and bond market, the yields are way down. Now, short term, you can get a 1 month for about, let's just say 4.37, I'll round it off here, percent. And you can get a 30-year bond for 4.6%. There's not that much of a difference. What's happening with our yield curve, and this tells us a lot about our economy. Long-term yields, like 20 and 30-year yields, and right now they're at 4.64 and 4.6. When they are low, they're telling us, and these are low, they're telling us the economy is going to slow. This is not a new phenomenon. These things have been low for a long time, for many years at this point. And we would expect to see the economy slow to a 1.5% to 2.5% growth rate for many, many years, given what we see there. Now, the other part, the manipulated part of the yield curve, is a short term, a year out, 2 months out, 3 months out. That's where the Fed has to figure out, how do we keep the economy going and people able to buy cars and homes? So if you're investors out there, short-term rates are what drives bank lending. Long-term rates are investors, typically professionals, investors' opinion on the outlook for the economy long-term. Right now, those rates aren't that far off of each other. And what that's telling us is that there's a decent amount of uncertainty in the bond market, and hence the stock market, of where the economy is going to go. Now, before you get all worried about that, let me explain something. 2024 ended very strong. When the bond market says we're really not sure where the economy is going, that doesn't mean we're going to, we're going to get hurt. That simply means it isn't discernible very easily. Normally, when you see longer-term bonds 2 or 3 or 4% higher than shorter-term bonds, that's normal. Right now, they're about the same in their interest rates, about 4.5 versus about 4.5, roughly. So, yes, investors are unsure, but we have come off of a very strong last quarter especially. And so long-term, we're doing okay, but there's a difference between that and paying off our debt. Okay? If we don't pay off the debt, it's going to get so big that we are going to have problems in 3, 4, 5, 6 years. So that's why we want to change the course of our economy from a bureaucratic type of or driven economy to a private business driven economy. Private businesses are actually productive. They create wealth. Government doesn't really create wealth. It just uses wealth that the private side has created.
It redistributes it.
And there are some benefits. A road that everybody can travel on. Yet the people on the bureaucratic side would say, "Hey, there's value in that." Yeah. However, if done in the private sector, that would probably be done for a lot less money. And keep in mind that original statistic I gave you: 25% of our gross domestic product, big chunk, goes through area code 202, paying off bureaucracies and even private companies who are working for bureaucracies, people who, defense contractors and so on. We have a lot of money being funneled through that, and that's not normal. We're really looking for a number more like, I hope you're sitting down, we're looking for a number more like 12 or 13. as opposed to 25. That's going to be the goal. Now, that won't happen right away, and it might never happen, but that would be the goal. And over a long period of time, that's what it was.
So reordering GDP and the effect on bonds and all of the headlines that go with it. Quite a bit to say here. We could go on for hours. I will mention one thing that Treasury Secretary Bessent came out and said just in the last couple of days. He said over the weekend that the White House is heading off a guaranteed financial crisis.
Yes.
And that is a shocking statement, right? For those of us that remember 2008 and were in this industry in 2008, that couldn't be a more sobering comment.
Agreed. And I'm going to add one more thing on there. This has to do with the combination of two things: tariffs and workers. Because you're going to see you have seen a lot in the media about the fact that we're not accepting immigrants. Okay, well, that's one way to say it. And we're tariffing the rest of the world. Well, when you really, on the average, our tariffs right now, if everything goes into place, our average tariff will be about 7% on the rest of the world. It'll go up from about 2.5% roughly to about 7%. Now, when you look at, I'm going to give you a comparison. When you look at how the countries in the European Economic Union, in one way or another, are tariffing each other, we are child's play compared to that. We're much lower than that. Okay, so we haven't been a tariff-oriented country for a long, long time. We've been paying tariffs, but we haven't been imposing them. We're simply going to begin to equalize them. And my hunch is that the president's real goal is to simply bring people to the table, because his long-term stated goal, his overall arching goal, is to eliminate barriers to trade, which would be perfect. Now, we're not going to get there, but I will tell, I don't know, this is an opinion now. Between Canada, us, and Mexico, I think we need to accomplish that, because as the goal of bringing industry back here, medicine, microprocessors, and I will call this all processing. Canada makes a lot of natural resources that they can't process. We have some processing capability, but we found out during COVID that our supply chain is not reliable. What do we short? I mean, Aaron, you probably know more about this than I do, but we are short on a lot of medications in this country. We cannot have that. And if the Chinese attack Taiwan, they are going to, the microprocessor business in the world stops. So now we have a very large microprocessor plant going to be built in Arizona, I guess right outside of Phoenix. But we need a few of those. So what we're trying to do is bring back the capability of not having our supply chain wrecked during an event of any kind. And we have water around us, so we're less likely to be, hit by bad people. And the condition that Bessent was explaining is exactly what Germany's going through, what France is on the verge of going through, what Great Britain is going through. Their backs are to the wall. They have massive problems over there. The question is the European Economic Union even going to make it? It's uncertain.
So when we navigate this yield curve, I want to land this plane for our listeners. When we navigate this yield curve, what I'm hearing from you is stay short and be patient. Is that a fair summary?
Yes.
Okay. So that's, thankfully what we've been doing.
Well, I'll tell you what, you're getting compensated just about as much for a short-term bond as you are for a long-term bond.
Right.
And I'll tell you what, this is one of the errors that our Treasury previously has made. In that when asked why they didn't lock in long-term bonds, in other words, issuing U.S. debt in long-term bonds when interest rates were at 2.5% for a 30-year bond, Janet Yellen's response was, well, we normally do it in three sectors, short, medium, and long, so we did it that way. So wait a minute. You could have been issuing our bonds at, say, 2 to 3% maybe. If you moved the market by issuing so many, maybe they'd be up to 3. And we wouldn't be in this mess, as much of a mess as we are right now. So we're with a different group of people who are thinking this through, I think, in a much better way.
So this is going to be a process, not an event.
But what I will also tell you that is, I think, very important, especially in fixed income bonds, is that there's enough uncertainty that professional management makes a lot of sense, because as bond trades, which are not nearly as volatile as stock trades, but as they move, they give professional management a chance to make you what's referred to as excess return over just the interest rate. You can make money in bonds. And that's very complicated, so I'm going to stop there. But especially in bonds, professional management all the way, 100%.
Chris, I wish we had more time to dive into that idea, and also the comment that I'll add, which is that the strength of the U.S. dollar is a phantom total return killer. Okay, we haven't talked about total return on this program. We're getting into that some in April, along with some vehicles and some whys behind why we do what we do, and that. But for today, let me just say thank you, and I'm really glad that we could spend this time together. You've been listening, everybody, to Portfolio Advisor Chris Gerber, CFA with Fideer Advisors. He's a 4-decade industry veteran who knows a lot about how markets move, the economic backdrop associated, and ways to navigate and to think about what you're doing. So, Chris, thank you again for your time, for joining us, and we'll be sure to have you back in future weeks.
Pleasure. It was a pleasure, Aaron.
This week ahead, let's look forward for a minute here, Chaz, with the time we have remaining. As for economic data, it's going to be a very busy week. Maybe most importantly, we have retail sales coming out on Monday. We have, we have housing starts on Tuesday, building permits, import prices, lots of data coming on Tuesday. Wednesday, the Federal Open Market Committee is meeting at 2:00. I don't have the time zone there. I assume it's Eastern, and there'll be a press conference afterwards. And then Thursday we have initial jobless claims and some other data coming out. So it should be a big week this current week of March 17th. And with that, let me just mention we'll have Paul Larson with us next Monday on the program. Paul's going to come and talk a little bit about the capital markets, as we have been at a high level, but also about stewardship in areas that aren't just about money. And so Paul, I call him Pastor Paul because he's a neat, experienced theologian, and also somebody that has capital markets experience, which is kind of a rare person to find. And so we'll talk with Paul next Monday, and we'll also the following week on the 31st we'll have a really unique guest join us on the program. His name is Tim Riddle. He's the CEO of Chartwell Investments, and I talked with him just in the last couple of days, and he confirmed that he'll be joining us as well. And that's the asset advisor to the Timothy Plan, right? A biblically responsible investing fund that's now in our models for the first time in 20 years. I was so excited. So Tim's going to join us and talk about what they're seeing specifically in the small and mid cap space. He may even have one of the portfolio managers of that particular fund join us. And so we'll get more into details about what Fideer does, how it looks, what's going on. So I look forward to that. Until that time, please do be wise and decide well.
You've been listening to A Steward's View with your host, Aaron Kolkman, president of Fideer Advisors. To learn more about Fideer Advisors or speak with Aaron, visit fideradvice.com. That's FIDERE advice.com. While there, you can also enjoy the free Fusion platform for portfolio aggregation. Just click Fusion at the top of the page. To listen to this and other episodes of A Steward's View, visit the website Fideer Advice and click on A Steward's View podcast link at the top of the page. Fideer Advisors is a privately owned full-service life planning firm offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plans for families it serves. Fideer maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions, and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com or call 833-2FIDARE. That's 833-234-3373.